Good afternoon, everybody, and welcome. My name is Anthony Kazazis, and I am the director of the NYC Network Group, as well as the NYC Real Estate Expo. And I want to thank you all for registering for today's State of the Multifamily Market Post-COVID webinar, sponsored by We Lend LLC. We Lend is a private lender focused on servicing real estate investors by providing quick and low-cost capital on their investment properties. We Lend's approach to lending is centered around the investor, therefore allowing the investor to focus more on their investment and less on their loan process. We Lend was founded by a group of real estate investors whose emphasis was on acquiring and improving distressed properties. So whether or not you are an experienced real estate investor, We Lend's team has the qualifications to exceed expectations and can assist in the expansion of your real estate portfolio. Today, you'll learn from commercial real estate industry titans as they dig into the current state of the multifamily market in a post-COVID landscape. When you have a question, everyone, please submit it, type it up, and put it into the Q&A section, not the chat section. Just in case, if we can't answer your question, we will copy it. I'll submit it over to the team at We Lend. They will also, of course, be sending out a thank you letter as well as a video, an edited video, and we'll do our best to answer all those questions that were not answered. Today, our moderator is Andrew Snitzel, partner at the We Lend LLC. Panelists today are Gabe Marquez, assurance partner at Cohn Resnick LLP, Lance Peterson, founder, managing partner at Veravest, and today we have Arya, who is filling in for his father, Greenwald, VP at Riverside Abstract. Gabe, let's start off with you, Gabe. Can you give us a little bit of a bio on yourself and your company?
Sure. Thanks, Anthony. Yes, my name is Gabe Marquez. I'm a partner CPA with Cohn Resnick, based here in actually Los Angeles on the West Coast, where I head up the commercial real estate practice. So I've been in public accounting for over 32 years. Focusing primarily on real estate construction, but happy to discuss, some of the dynamics we're seeing in the multifamily sector today with the panelists.
Thank you, Gabe. Lance?
Yeah, thanks everyone for having me. Appreciate it. Yeah, so I'm Lance Peterson. I'm the founder and managing partner of Veravest. We're based in Portland, Oregon. We've got clients all over the country. We have 4 different components to our business. We've got a fund formation advisory practice, which I head up. It's all real estate related stuff, commercial, residential. And then we have a fund administration practice, a partnership tax practice. We recently launched a sponsor directory and marketplace to help connect investors with deal sponsors. So we're really kind of end to end trying to service what we call real estate entrepreneurs around the country. So thanks again for having me.
Yeah, thank you, Lance. Arya.
Thanks for having me, Anthony. You're doing a great job so far. So we have a title insurance agency. We service all 50 states. We've done about 2020, even though there was the pandemic and business was slower, we still did about $20 billion in transactions. We have about 150 employees with us right now across about 6 offices. We have our sister company, Riverside 1031 and Riverside Tax, which handles 1031 exchanges and cross segregation. And we've done about 6,000 deals last year. So we've definitely seen enough deals to share some of our thoughts.
Very impressive. Thank you, Arya.
Anthony, thank you for having us. So I'm a partner at We Lend. We are a nationwide private lender. We lend on both residential, multifamily, and mixed use assets, all nationwide. We excel at just providing quick, low cost capital to our investors. And we just pride ourselves on the certainty of execution and quality of experience that we offer to our investors. So let's jump right into it. So the first question is for Lance. So Lance, what trends are you seeing today from the multifamily debt funds that you work with?
Yeah, I think one of the trends I've noticed in the last 12 to 18 months across our debt fund clients is beginning to explore how to do more pref equity mezz debt deals. Those are more and more common. I think people are realizing a way to kind of get into the capital stack and position themselves, especially the ones where they might have their own operating platform. It's not the worst thing in the world if you make a deal to an operator, and if they can't execute, they could step in. But I just think it's more commonplace, and given the where we're at in the market, it just ends up being a really good way to boost yield in the funds, and makes a lot of sense. And just the bridge product in general, right? It's just the faster, the speed of close, working with guys like We Lend, and that's really what in a market like this you just need. It's just a lot more important that you can execute and get a deal closed fast. Whereas the conventional sources sometimes can kind of drag it out. That's definitely a big trend we've been seeing.
Totally. I think that during COVID, it really slowed down the timeline that it takes for banks and other conventional lenders to close. And we've just seen a need for quick capital in order to get deals closed. So next question is for Gabe. So Gabe, how would you say COVID has impacted the tax strategies that multifamily investors use in today's market?
Yeah, no, great question. And as we all know, anything real estate does often start with, the tax planning, the tax strategy, and the tax efficiencies that can be had. One of the things we recall is just over a year ago in March 2020, the CARES Act, which was a stimulus bill that came out as a result of the pandemic right when it first started. It provides an opportunity for an investor of any asset class, but let's talk about multifamily, who had previously elected not to have interest expense limitations. And so they defaulted into what was called kind of this alternative depreciation system, where they're going to use 40 years for the depreciation expense. What the CARES Act provides now is an investor could now determine what depreciation expense would have been had they depreciated that building over 30 years, so slightly accelerated. And you can submit an adjustment form for this accounting change to effectively kind of catch up on depreciation expense and file it actually with your 2020 tax return. So that's one of the kind of very common and popular tax strategies that we're seeing coming out of the pandemic, and of course for multifamily investors.
So next question is for Ari. So Ari, how would you say that COVID changed the multifamily transaction flow that Riverside has seen?
Sure. So pre-COVID, we were seeing a kind of an even flow of transactions that were happening between New York, New Jersey, and out into what we call out-of-state transactions, out into the rest of the states. In a COVID world, we are really seeing between what happened June, I believe it was June 2018 with the new rent laws in New York City, we've seen a lot of those transactions definitely move out of New York. And we're seeing, a ton of transactions out of state. If you want to ask me the state specific, put your finger on a map, it's happening there. It's the pricing out of state is going up like crazy just due to the demand of New York buyers going out into those states and buying, but it's really blown up tremendously.
That's exactly what we're seeing on the We Lend side as well. We're seeing a lot of deal flow coming in from markets like Florida, New Jersey. We've seen deals coming from Alabama. Just all
a lot of the red states specifically.
Totally. All of our New York investors are going out to markets, and definitely a lot of red markets like Texas, Florida. So next question is for Lance. So Lance, what markets do you anticipate that the multifamily debt funds that Verivest works with, what markets do you think will be most active in post-COVID?
Yeah, you know what? I talked to a lot of guys, basically all day long, talking to operators. I mean, the vast majority of them, Texas is obviously super hot. I mean, just the Sun Belt in general, the Carolinas, Florida, seeing more Tennessee. I think people are, starting to wake up to like the Boise, Idaho market, Salt Lake City, Phoenix. I mean, I'm not saying anything that's sort of like, a shocking development here, but it's just, you're seeing this, what I think will probably be, called the great reshuffle. When we look back here, it's just people are just, the whole COVID thing just caused everyone to kind of reassess their situation. Obviously, we've now proven that you can work from wherever you want. So you are seeing, as you guys were alluding to with the New York City markets and obviously San Francisco and Chicago. I mean, it's just all day long, that's all I hear. It's just about how everyone's sort of, moving out of those markets and sort of dispersing into these other, weather obviously being a big part of it, right? Just if I can live wherever I want, then I might as well go live in the Carolinas. It's beautiful there. And as you said, Ari, right? Like, I mean, the red states, it's just a big part of it. I mean, there's just, you can't ignore it, right? I mean, they're leaving California, they're leaving Illinois, they're leaving New York, and they're going to places that are just more friendly to do business in and have nicer weather. And, but yeah, it's been very, 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 very interesting.
Yeah, and I think that term that you use just really nailed it on the head, the great reshuffle. I think we're all kind of just waiting to see how things are going to pan out over the next year or two. So next question's for Gabe. So Gabe, what effects do you anticipate that OZs or opportunity zones will have in a post-COVID multifamily sector?
Yeah, no, another great question, Andrew. And look, I mean, I think with the pandemic, we do expect an increase in the interest for investors to look at opportunity zones, particularly in the multifamily market, because obviously what COVID has done, it's heightened the needs of distressed low-income communities to be revitalized, right? So just to kind of frame the discussion is, opportunity zones, came about, in 2017 as a result of the Tax Cuts and Jobs Act. And it provides tax advantages to investors who take proceeds, say, from a capital gain, like the sale of stock or a business, and invest them through a fund into a qualifying project in a designated, zone. The challenge right now with opportunity zones, it's in the very early stages, and there's some disconnects that are rising between investors and communities and what the priorities should be. But people are starting to realize, these are government tax incentives, and the government is having fewer and fewer tools at its disposal to provide subsidies like this and encourage alignment. At the end of the day, these mission-oriented projects, which are largely what opportunity zones look at, they're going to struggle to compete with, higher return projects, because as investors, people are looking for higher returns. But what is interesting is opportunity zones, are this new form of investment, deserving of serious consideration and engagement from all corners of society, particularly when the stakeholders have an interest in community redevelopment, right? So I think as stakeholders kind of, exert their influence and interest in the investment committees about, hey, let's take a look at this opportunity zone opportunity. I think that's going to propel more interest, and eventually, we'll see more traction, in this space. I'm pretty excited to see what happens, and I think in the coming, months and years, we're going to see opportunity zones, more present in fund investment portfolios.
Totally. No, I entirely agree that it's just very early on in the OZ space, and that it's going to take time for it to mature. But ultimately, it's going to be about the return on each project that's going to determine whether an OZ deal makes sense or not. So next question is for Ari. So Ari, just a follow up to the last question that I asked you, do you expect the trends of New York investors going national, going to other states, do you expect that trend to continue post-COVID?
It's an excellent question. It's not a question it's a question I wish I really had the answer to, because I have nowhere to put my money. I don't see it letting up anytime soon. I think the point is that once people really get out of New York and out of the concrete jungle and they move out to the Carolinas and these warmer climates, and they're paying, a fraction of the rent that they were paying in New York markets, and they have 80 degree weather mostly year round. At that point, after living there for potentially a year, 2, 3 years, I think the conversation is gonna have to be, hey, why would we move back to New York? So I don't see it letting up anytime soon.
Totally. And I think that just people who have moves to other markets, to Florida, to the Hamptons, to down south, once they've picked up and they've just moved their kids, put them in school, it's going to be
Correct.
difficult.
And sorry, and just to add to that, I mean, now, especially with a lot of the new tax plans that are coming out, right? There are significant, values as far as just for tax planning purposes to really get out of New York.
No, entirely. I mean, we're looking at 50% taxes for our tax bracket in New York, whereas in Florida, it's a fifth of that. So you kind of see why people are leaving, especially with all these big institutions such as Starwood and Goldman Sachs looking to move their asset division down to Florida. It seems like it's just starting, to be honest. So next question is for Lance. So what prediction would you make for multifamily construction trends to occur in a post-COVID market?
Yeah, I don't know if I'd go as far as like making predictions. Not much of a prognosticator there, but I mean, what I've been hearing from people, right, is that there's certain markets where it makes sense. It's starting to pencil out, right? And I think that look no further than Dallas Fort Worth is an example. I mean, you've got all these people moving Austin, Texas, Florida markets, Orlando, Tampa Bay. It's starting to make sense because of the cap rate compression. It just makes more sense to potentially build, right? And there's not enough supply, so you got a supply and demand issue. But I just think that that's market to market, submarket to submarket. And I think the other issue right now, of course, is that the cost of the construction material costs are through the roof. Lumber is crazy. I mean, that's going to make it a little more difficult for some of these deals to pencil. But that's what it comes down to. Much like your OZ thing, is that it all comes down to the economics. These things have to pencil out. If they don't pencil, then you don't do it. And, that just depends upon the market. But I am, seeing more of that. And I think as a good example, I know one of our clients is in Dallas Fort Worth, and he's built a whole fabrication. He's got this industrial warehouse where he now has all the machinery to do this light gauge steel. So he can basically go in there. You don't need lumber, right? He can basically fabricate 2-3 story, multifamily buildings in the factory, bring it on site, tilt it up. And, so the speed and then the cost obviously starts to make a heck of a lot more sense. So I just think that you're seeing some interesting things, but getting those units online and it's to me between the like repurposing of, converting hotel motel to sort of workforce housing. I mean, everyone's getting really, really creative as to how to reuse what exists or find alternate materials to construct in. And it's pretty cool to see the creativity and the technology that's being employed now in the real estate business, which has been lagging really every other industry for a long, long time.
Totally. I mean, we're starting to see the use of all sorts of new technologies in order to build residential and multifamily assets. We recently toured the first 3D printed house in America in Riverhead, which our friends built. And it was just mind blowing to see a house that's being able to be put up in a couple of days. And that combined with the advances in prefab technology, I think that there's going to be a shift in the market for a variety of reasons, but that we're going to see a lot more of those sorts of deals in the coming years, especially due to the rise in the cost of goods, particularly lumber.
Yep.
So next question is for Gabe. So a lot of people have kind of just been skeptical in the real estate sector about Biden coming in and like what he's planning for the real estate sector in general. Biden's talked about getting rid of 1031 exchanges. If this were to occur, what would you anticipate the effect would be on multifamily acquisitions nationwide?
Yeah, no, great question. And we've heard a lot of the same discussion around, with the new administration, what is the strategies around 1031 exchanges or capital gains for that matter. And you would think, and just anecdotally, if 1031 exchanges were to go away, you would expect probably fewer multifamily assets to be traded between owners and investors, particularly those that were motivated to execute a purchase or sale to take advantage of the 1031 exchange rules. And I mentioned capital gains as well. That's another area that a lot of us are watching closely, because I know there's been indications that capital gains tax would go up. So, the tax planning strategies around this, some saying, okay, if 1031s go away or not, if capital gains rates, tax rates go up or not, looking here in the shorter term, some are contemplating, do I pay my taxes now while the capital gains rates are a little bit lower? So again, an area that's very challenging, and hopefully there'll be enough, runway as far as if the administration does talk about, removing 1031 exchange, or where it's going to set the capital gains tax rate at. Hopefully there's enough runway and time for people to effectively plan for what they want to do. But I know that should be kind of a key priority right now for all multifamily asset investors.
I think a lot of private family offices and other investors, such as funds, are kind of just sitting on the sidelines right now and just waiting to see how things play out. I mean, one, with 1031 exchanges, and also just to see if there's going to be any widespread distress in the multifamily market. So people are just kind of taking this wait and see approach right now.
That's right.
So next question is for Ari. So Ari, what cities in particular are you bullish or bearish on for multifamily transactions post-COVID? And feel free to break that down into class A, B, and C multifamily as well.
You're throwing all the difficult questions at me. You have it out for me, Andrew. We're seeing a lot, and I think we'll continue to see a lot post-COVID, which we keep saying over and over, which is the same markets. Dallas, a ton in Houston. I'm seeing a lot in San Antonio. The Cleveland, Cincinnati markets. We're seeing the North Carolina, South Carolina regions. Georgia is, if you owned an asset in Georgia 2 years ago, whatever you bought it for, you're in good shape today. Florida, anywhere that's warm, that's red. I think Georgia has actually turned into blue with this election, but they're still operating pretty red right now. And moving closer to north, I think that even in the Connecticut markets, surprisingly, I'm involved a little bit in the Connecticut markets, and I think that even though it's really a blue state, there are a lot of advantages to that as well. There are plenty of value-add programs and green programs that you can take advantage of. Now, I know I have a lot of clients that replaced all the appliances in all their buildings practically at no cost by taking advantage of certain programs. So in each market, in each either blue or red, you just really have to know how to play that politically and how to take advantage of either the programs or the lack of programs, but the ability to really go out and kind of do what you want. I'm a New Yorker, so I pray every day New York comes back to what it was, because it's kind of sad and disappointing to see what happened to New York, which is always our great city. And I do think that, I don't know if it's 2 years, 5 years, or 10 years, but New York will come back.
I think that, there's large institutions such as RXR and related who are making literally multi-billion-dollar investments in New York. And I agree with your sentiment that, hey, who knows when that's gonna occur, when there's gonna be life back in the city. But I think that there's many large institutions who are very bullish and who are looking forward to New York returning to its glory days. I think we are all kind of waiting for that to happen. So next question is for Lance. So Lance, what do you anticipate is going to happen to multifamily owners after the eviction moratorium is lifted in respective states?
Yeah, I mean, I think it's going to be interesting. I guess my sort of anecdotal evidence of just talking with people, I don't seem to run into many people who have, serious delinquency issues, and maybe I'm just talking to the wrong people, but it doesn't seem like there's much of a problem. So I guess I'm just assuming that what's happened is that, this unprecedented stimulus program that we've been executing sort of staved that off. And now you're seeing, I think, even in the Journal this morning, it's those without, the unemployment numbers are looking good. I mean, people are getting back to work. And so, I mean, I think it feels to me like, when they lift these moratoriums, I'm sure it's going to displace some people, that aren't going to be able to come up with the money and, those sorts of things. But I don't think that it's going to be sort of this widespread, gigantic issue where the performance of these assets is going to fall through the floor or something. I think it's going to end up, as it always does, right? It's those who, it's the people who are already sort of in dire straits maybe before it happened, or just it's going to be tough for them. But I just don't think from an industry wide perspective that it's just going to be this bloodbath that's going to cause, prices and, to fall. And, I think what people were saying back in April, May last year is just doesn't seem like it's going to happen. I think we've just inherited a different set of problems that, will rear itself here in the form of inflation or, any number of other things. But we've probably, the stimulus probably did what it was trying to do and not make that so much of an issue. I could be wrong, but.
And Andrew, if you would mind, if I can just add to that, and I agree with you, Lance, your perspective, and it's really, about, multifamily owners, right? So when the pandemic hit, you starting probably in April of 2020 last year, you may have saw some tenants not paying their rent, right? So, the moratorium goes into effect and the restrictions on evictions, started, and they're in place today in many areas. Talking to some of my clients that own, multifamily apartments, they're saying, hey, when the moratorium is lifted, I'm not really motivated to kind of evict people because I'd rather have a tenant in there than not. I'm more concerned with, the arrangement we had in place on the deferred rent. So if a tenant appropriately approached their landlord and said, hey, I'm going to need some time to pay rent, and there was a kind of a deferred rent arrangement in place, I think that's a positive for the landlord and the tenant, right? For those tenants that just were silent and maybe just kind of stopped paying rent and really didn't have a good communication with their owner, the landlord, when those moratoriums are lifted, that's when the landlord and investor is going to have to decide what they want to do, because technically that tenant is in violation of their lease agreement. They didn't pay rent timely, they're in violation. So, in that case, the landlord, the owners have, hold the cards a little bit on their decision. But like I mentioned at the beginning, I think most landlords would rather have a tenant in there and have the intent and hopefully ability to pay than to have a vacant unit.
No, totally. I think that, at the end of the day, everyone wants to see occupancy rates high. But I guess time will tell as to what exactly is going to occur as things return back to normal. So next question is for you, Gabe. So how would you say that COVID affected multifamily and multifamily owners?
Yeah, just kind of expanding on my comment a moment ago, I think what you first saw was some tenants, not having the ability or intents to pay rent. And so we did see that dip in cash flow. Recently talking to a client, and they were looking at their numbers through the first quarter here of 2021. And I think their statistic was roughly about 27% of their cumulative portfolio tenants were 1 month behind in rent, which sounds like a big number, but it was much larger 6 months ago. And I think they've had some outreach to the tenants to kind of discuss what their plans are going forward as far as to make good on any deferred rent arrangement, or to let's put in place a deferred rent arrangement Not seeing a lot of concessions where there's forgiveness of rent, but I think owners and landlords alike, I think they're going to want to work with the tenants, not to forgive the rent, but basically work out a payment plan effectively to collect that deferred rent. So look, the tenants, as Lance and Ari kind of commented, there will be some tenants who just were probably in difficult situations to begin with, and the pandemic just kind of added to that. So there will be some displacement in that regard. But as from an investor owner perspective, I think there's there's much need for housing. And I know, looking across the United States, with the pandemic, you saw, and the workforce, people being able to work out of the office, work from home. So they wanted to have, more space. So possibly move out of a unit in the city somewhere and try to buy a home, New Jersey, adjacent state or community. Well, what you're hearing now is, the housing shortage is so dire. There's a need for new single-family homes, new as well as those existing homes. So, people got to live somewhere. So I think that's going to continue to sustain the multifamily occupancy levels for a period of time until the single-family home industry can kind of, pick up pace as they appropriately can on delivering more home units, if that's the direction some folks are looking for their housing options.
Sure. And I also think that with the government while they keep on popping out all these stimulus checks to tenants, like that's going to have a significant effect in terms of people are going to pay their rent. So hopefully that keeps some stability or continues the stability in the multifamily sector.
To add to that, we actually have a very close friend and client who owns mostly property in the Bronx and Harlem area, and any of his tenants that had trouble paying rent throughout this period, their office actually spent a ton of time with them, walking them through the process and how to get government assistance, and they were actually helping them get some personal funding so that they can afford to pay their rent.
I guess the question is how long these stimulus checks are going to last, and when they dry up, what's the effect? Is that going to cause a huge correction in the market, or will it remain stable? So next question that I have is for Lance. So Lance, how do you expect the current rise in the cost of construction materials will impact a post-COVID multifamily market?
I mean, I think I kind of alluded to it earlier, right? I think it just comes down to if those, let's put it this way, right? If we weren't seeing the increase in the cost of lumber, I think you'd see a more robust, maybe Gabe can speak more to this in the construction side, but you probably see more people pulling the trigger, right, to develop. I think right now it's causing them to sort of pause. And probably more so even on the single family side with home builders. I talked to a guy yesterday who's building in Indiana, and it's definitely, it's what I expected I'd start hearing is this. It's making them nervous a little bit, right? Rethinking it, like, do we do this? Because they all sort of, I mean, many of them lived through the last downturn when they got left holding the bag with these lots that they had borrowed from the bank on, and so now they're going, oh man, what if we, it's just they're gun shy still. And I think that, I mean, clearly they were, and this is why we have such a shortage, is because it all got put on the deep freeze for how many years there, right? And then most of the activity, as we saw, was sort of just rehabbing the product that was already in place as sort of the solution, which I think was a good thing, obviously, but there were really not that many new units being brought online or homes online. And so it just seems like that's what it is. It's just when you see things like this, it just causes people, it's more uncertainty, right? And the more uncertainty you have, people, especially with what we've all gone through in the last 12 months or so, we all learn it's just better off just to stop and don't take action and don't go too crazy here. And so I think that's the big thing. But I think some of the benefits of this are, as we talked about before, it's just there's other materials, right? Whether it's, 3D printing or just, light gauge steel, modular, prefab sort of stuff, which I think is a good thing. I mean, that's innovation and people figure, I mean, this is why I love being a part of the private sector and being a business owner and in a democratic country that's, a bunch of capitalists. Like we're going to figure it out, right? Like there's competition, we run into problems, we find ways to get creative, to innovate, to solve these problems. And that hasn't changed. And so I think that's the same thing. And it's going to be, as we said, market by market. I'm interested. And I think one of the people in the Q&A, someone was mentioning Ronnie White here. He's saying, Texas energy grid, and there's issues, right? I mean, if all these people are moving to Texas and all these things, and their energy grid, can't handle this increased capacity. Not to mention like climate change, a big, another big topic that people. But I mean, you can't ignore some of these things. It's just there's more. It's getting hotter and hotter, and there's more, hurricanes and, all these things just seem to be popping up right and left. But yet that's where everyone's migrating, is to those same places. So it's just, just dealing with all of those things and what they mean, I think, is just a lot of the stuff's unprecedented for many of us. It's just not following the patterns that we're accustomed to seeing. And we've kind of we don't have our compass, so to speak. So.
I think that a lot of banks and those conventional sorts of institutions have either pulled back entirely on ground up construction for residential multifamily. And essentially what's happened is that there's been a flood of deals into the private sector. And I think that a lot of investors don't want to work with banks just out of fear that, hey, in the middle of the construction, the banks are just going to say, we're not giving you a draw. I think that a lot of investors want the certainty of execution from a private lender on the construction side. And I think we're seeing deals just come in nationwide of just subdivisions and ground up apartments. And I would anticipate that that's going to continue in the coming years.
Yeah, Andrew, real quick to add to that, what I am seeing in some areas where, a multifamily apartment owner may have some vacancies, they're taking advantage of this time to do, kind of some planned renovations and maintenance there at the facilities or at the apartments, because you can kind of, work with tenants to kind of, get them all on one floor or one specific building. So where there has been, a little bit of, slowdown on new ground up development, those that have purchased multifamily assets in recent years with the plan to eventually do some repositioning of that asset through renovation and the like. Some are taking advantage of that because it's pretty cheap money for the most part, short term, as you guys know, and they can kind of have units, available and ready to go, once people want to kind of, can resume, deciding where they want to live, in an apartment, in a home, and wherever that might be.
Totally, and that's exactly what we're seeing at We Lend. Just a lot of repositioning transactions. And I mean, I think that's going to be a lot more popular than ground up for the next, I would say, 12 to 18 months. But time will tell.
The world transitions into bridge lending.
Yeah.
Right. At this point, your bridge rates are almost touching on agency rates. So if I have a little bit of value add, I may as well take that bridge with more flexibility and higher LTV than go the agency route.
Yep.
I think that with all the rate compression going on, that in the coming years, private lenders are going to be the new normal for a lot of investors. I mean, both on the permanent side and on the bridge side. So next question is for Ari. So how do you think multifamily is going to fare in the coming years relative to other asset classes?
Good question. I think Lance touched on it, but in the office market, you had people that said, hey, it's working. I don't have to be in the office and everything is fine. I've yet to hear a conversation of, hey, I've been living on the street for a week. It's working. I'm not going back home, right? So everyone needs a place to live, as Lance mentioned, and multifamily will always, in my opinion, have a demand that isn't going away. On the office side, it's really, I mean, you could speak to 5 people and get 5 different opinions. I personally do believe that office will come back, but more for the, let's call it mom and pop office, the medical spaces, right? Those are always going to be high in demand. When it comes to the tech world, which we're seeing is there's really no use in office space. At least that's what they feel. I don't see the big office spaces and the huge 100, 200,000 square foot leases. I think that's where we're going to see a little bit of the problems. But on the small leases and the the mom and pop leases, attorneys, accountants, medical, I think that'll definitely be strong and continue to be strong.
I'm also very bullish on, besides for multifamily, industrial.
Oh, for sure. That's an excellent point. I mean, you have people that are just buying, 1 million square feet of industrial and doing a single tenant lease to the Amazons of the world. And there's a crazy demand for it, as we know. And yeah, we've definitely seen a crazy amount of volume in the industrial world.
Exactly. No, I think
That's a good point.
the Amazon effect is really just changing the industrial sector. And it's also just the demands for the sector throughout COVID and post-COVID, I would imagine would remain robust. So next question is for Lance. So Lance, what do you think is going to be the effect of rate compression on the multifamily debt funds that Verivest works with?
Well, yeah, I mean, I'm not sure I can answer that. I mean, I think that my hunch would be that the cap rate compression makes it a little bit more difficult to get comfortable with the V and LTV, because it seems to me, I mean, what I hear, from clients is that, in many of these markets, they're looking at the cap rates for a value add, B to C, and what they could pay to get a class A. And they're like, well, I might as well buy the class A. I mean, there's more value there, right? So you're seeing that shift. And I think that if I'm looking at the questions here, I mean, Raquel or, someone's asking that whole, man, it just seems to me like stuff's really expensive in the market. Like, how can I transact when everything seems to be overpriced? Well, that's universal. So everyone I talk to is basically saying that, like, I can't, every deal I look at, I mean, even if I even decide to put an offer in on it, I'm being outbid and it's going and someone's buying it. So there's some, what they, of course, all the participants think is dumb money that's basically transacting at some price that they would never in a million years, acquire that asset for. So I just think that, and then when you put yourself then in the lender's shoes, that's stuff that makes underwriters super nervous, because I mean, of course, it's all about your advance rate. I mean, what are you willing to do, right? But I mean, if you get a little, over your skis here, especially on it seems like this market just keeps going and going and going and going. Well, I don't know if you guys, can remember, it's been a long time ago now, but it's kind of how it felt in like 2005 and 6 and 7 in the single family market. It just seemed like it cannot keep going up and up and up. There's no way, right? And then the bottom fell out of it. And so, and of course that was a different situation, but it does feel a bit like that because you do have people out there that are buying who keep saying that it's going to keep going up and to the right. The value is going to keep rising. So I need to acquire these things. So, I mean, being in that lender's position, and as we've talked about, with the agency debt or the conventional lenders who are, as bridge lenders, you need to feel good about your exit. Like who's gonna refinance this deal, right? And so it's just those are the things where we talk about, and it is great. I mean, I think that once again, as I've already said, I mean, I'm glad that the banks have sort of receded and really lending is not as much of a part of their business as it once was. And that it's great because it allows private capital, which there's plenty of and always has been, to sort of flow and work, and kind of do that work more so than it just being so one-sided where that capital was coming from. So I just think that that's how the impact of this rate compression, it's sleepless nights for underwriters would be my hunch. It's just trying to figure out what is this thing going to be worth, and especially if they're executing some value add play when you're looking at what's the value on the other side of this thing, and it's a little tricky.
Totally. And I think the good deals that we're seeing are just found in novel ways. Just people finding distressed assets in one way or another, whether it's an estate sale, whether it's just someone who's in over their skis. Those are the deals that we're seeing are actually getting done in today's market, and I would anticipate are gonna get done a lot more actively in the coming months. So the next question is for Gabe. So Gabe, do you think there's gonna be distress in the multifamily market once all of the COVID eviction moratoriums and restrictions have been lifted?
Yeah, I mean, we touched upon that a little bit earlier, and like Ari commented, Lance commented. I mean, people got to live somewhere, and I think with the cost of housing, if you have a choice between single family home and multifamily apartment, there's going to be more options at more different price points for people to afford in multifamily. So I think multifamily, it was commented, like industrial, are two asset classes that have, for the most part, I think have weathered the pandemic relatively well. Industrial obviously done very well with the Amazon effect and everything else. Multifamily, yes, there's been some vacancies, there's been some slow pace on deferred rent, but I'm not seeing it bottom out necessarily. So still pretty optimistic that multifamily housing in a lot of the markets that people have commented on, will continue to be strong. The whole return to work concept is going to be very interesting. Whether it be service firms like CPA firms or law firms or other businesses, commercial real estate is where people are still waiting to see what's going to happen. It's possible that there can be some, assets in that space that are gonna have to come to terms with how they want to, re-envision what commercial office space looks like for a return to the office as that starts opening up here more and more. And you imagine that a lot of employers, you hear different statistics, right? Some employers saying, hey, only a good 25 to 40% of my workforce is going to continue to work remotely. So that means, I'm only going to need space for 75% of my current workforce. We're going to see what that office space needs to look like. So that's the one where a lot of us are keeping a watch on, because a lot of office space was built. Of course, office space has a lot more longer term leases. So expect a lot of renegotiations in the office lease space. You add on top of that how much office space is expected to come online here within the next 12 months. It's just going to complicate the situation.
Just to touch on that point, because you piqued my curiosity, but to move away from the multi just for a few seconds, on the office side, do you see the major firms, if they're saying, okay, we're not bringing anyone back to the office, right? I mean, I was out of the office April 2020, May. I was on my sweatpants for about 2 months, and I was about to lose it. At a certain point, it gets increasingly difficult to work from home, especially if you have young children at home. Do you feel that the WeWork concept will start to actually get stronger now that people just need a place to go to set up shop and work for the day?
That's a great question, all right. And that's what a lot of people have looked at. They're saying, hey, the return to the normal office setup may not happen, but if I need kind of to go, locally in my community rather than commute into the city for an office space, I can go down the street and can WeWork, resurrect that. I think it will to some degree. I'm not seeing people clamoring on that quite yet, largely because employers are still waiting to decide what they're going to do. Most will probably tell you they're going to offer some option to their employees to continue to work remotely, work from home, depending upon their family situation. Kids return to school, caring for family members. It's just more than, it's a multi-factor consideration, but I think those that have been supporters of like the WeWork model are looking at that saying, hey, this might be kind of how we resurrect, after obviously they had some challenges this past year.
I think just to take that one step further, I'm really curious to see what's going to happen in retail. Just because so many people have gotten used to buying things online, is that going to decimate retail in the coming years?
We'll discuss next year at the panel.
Yeah, exactly.
Stay tuned for the next one, the retail panel discussion. Sure.
Yeah.
But you're right. At a high level, retail's rethinking what it needs from a brick and mortar perspective, right? So whether it be gyms, movie theaters, these power centers, some have done well. Your Lowe's, Home Depots, those have been strong. But your retail department stores, your Macy's and the like, those are the ones that look like they're going to be having to make decisions on how much space they need to occupy and whether they really feel shoppers are really bought into this, the online model, not just with Amazon, but perhaps at their own website.
So the next question is for Ari. So Ari, with the transaction flow that Riverside has seen since the start of COVID, have you seen any widespread distress in the multifamily sector?
So we don't see the distress side as much because we're seeing all the good stuff, right? We're seeing the purchases and we're seeing the refinances. That being said, the answer really lies in our conversations with our clients. We have some clients who were buying, a ton of assets and super active, and COVID hit, and they really just closed up shop and said, we're not buying anything anymore. And what we're going to be doing for the next 12 to 18 months is assemble a fund so that we'll be ready in 2021, 2022 to start buying up distressed debt and start buying notes, because they feel that it is going that direction, and they think there's a business to be made out of that and to take advantage of. But really, we're really not in that world to really see the distress. I think Lance would see a lot more than that, a lot more of that being in the lending world. And we're seeing the transactions, so it's all smiles when someone's purchasing, and it's all smiles when someone's refinancing. So it's really hard to see, the distress in our industry.
Sure. And Lance, what are you seeing on that front?
Yeah, I think it seems non-existent, right? So, and if there is distress, same thing. I don't have purview into it because it means it's in special servicing or whatever. But across our client base of operators, there's not. I'm not seeing it, right? I'm not really seeing distress of any kind, and we've got, really, our client base underlying assets are pretty much every property type you could imagine, just not seeing anyone really struggling.
In New York as well, Lance?
Don't have as much exposure to New York. I guess the client we do
Right.
have are the people who are buying the distressed notes from the banks. They've always been doing that. So, I think that it's there. It's just we're not really in that upper end of the market to see that specific kind of distress. It's more of the middle market.
And ultimately, there was a good line that a client told me that, if you owe $5 million to the bank, you have a big problem. But if you owe $100 million to the bank has a problem.
Yeah.
So I think that the banks are going to, like you said, are going to be working with their borrowers as much as possible, because they really don't want to take the keys back and leave the problem on their shoulders.
Yep.
I think assuming that happens, then it'll kind of be a return to normal a lot quicker, and we won't see any widespread distress. So I'm going to open up to questions from the audience. We had quite a few questions come in. One of my favorites is from Raquel. So Raquel asked, do I buy a multi now or do I wait? So Lance, I'll let you handle that one.
Choose your words carefully, Lance.
Yeah, exactly. Well, I mean, of course you should try to transact. I mean, I host a podcast called the Real Estate Risk Report, and this is, it comes up. I got a lot of guys who are multifamily operators on the show. And this is one thing that comes up all the time. I think that my answer to you, Raquel, and anyone who's looking to, do deals is that you have to have a method to your madness, right? Like you have to have a process about how you acquire potential opportunities, the way you bring those deals in, the way that you underwrite those transactions. If after assessing what you've been given, it meets your criteria, right? Then you should attempt to transact and put an offer in. So I just think that that's always the case. It's just that now if you're a disciplined underwriter and, it just depends upon your risk tolerance, right? That the answer today will be no more than yes. Whereas in 2016 or 17, the answer ended up being yes more than no. It's just, that's the whole rub right there, right? So most of the people, the guys and gals that I talk to on a daily basis, I think they consider themselves more, I don't know, disciplined is the word that comes up a lot, right? And they look at some of their peers whose process is basically put an offer on every single property that they hear about, and that's literally their strategy. So then they end up transacting when they probably shouldn't be because clearly someone's buying these assets. Someone's paying what we all think is more than they should be. And
it depends on your investor base. If you're a syndicator, right? If your investor base is, they're thrilled with 5% returns, well, those are your buyers for the 4 caps, right? But at least in my world,
exactly.
I really wish I had investors at 5%, but in my world, it doesn't fly. So it's really, I find it's a patience game. It's how many deals could you underwrite without going crazy to find that deal that was mismanaged or, has a 40% vacancy for a mismanagement reason, and you can come in and really put those, blood, sweat, and tears into it, and that really is going to separate you from everyone else that's just putting offers on, stabilized Class A, Class B plus deals.
Yeah, that's right. It's where your capital's coming from and what they're comfortable with, and then your ability is just an operator and just the ability to execute a business plan, and because that's what it ultimately will come down to, is that if it's skinnier deal, then you better be a really, really, really good operator, right? And I think that many of those guys who've been, or gals who've been in the business a really long time, can probably get away with it. They can figure out how to make it work, but I think it will be hard for emerging, operators and people looking to get in, where you need a little play in the system to make it work. You can't, and it just seems like most transactions, there's not that many of them out there right now.
You touched upon it earlier, Lance. It's the V and LTV that's the challenge right now.
Yeah, that's good. Yeah,
Very true. I think that, for investors who are entering the market now, they just need to be patient and wait for a deal where there's upside, and not just try to find the first market transaction that they can get their hands on. But with a lot of the syndicators out there, their business model is to charge fees. So they're looking for any deal that they can get their hands on. So the next question's from Levy. So he's asking, many of my investors are telling me that it's hard to find good deals in this market. So he's asking, why is this happening now? So I'll open that one up to you, Gabe.
Yeah, and just to extend upon what Lance and I were mentioning, Andrew, is it's the value and the strategy, right? So does your underwriting pencil out? So everyone would love to get a deal where it's you're not buying something in the 4s and the cap rate in that area. But what I've seen with some of my clients, they're looking at deals, but it's also their strategy. So some who are more opportunistic, who are going to put some money into the property, reposition it, perhaps combine units. People are looking for more space. So if you have an apartment building that's, you have, 800 square foot, units. But if your strategy is to acquire that and maybe combine a couple, so you now have a 1,600 unit, that might be more attractive for a family to spread out, to continue to work remotely. So if you're seeing all these types of creative strategies on saying, what can I do other than just keep the typical box multifamily apartment? Where can I be more attractive to potential renters? And of course, command higher rents too as well.
And I think that's going to be the name of the game. It's just increasing rent, especially as inflation increases. We're going to see an increase in rent nationwide, coupled with the increased demands in these assets. Those two variables are really going to increase the cost of rent in the coming years. And then the last question that we have is directed to myself. Specifically, it is
what makes We Lend so great?
It's these webinars.
I forgot to thank you, Andrew, by the way, but on behalf of all of us, really thank you for putting this together and the team. I know it was a big effort, and you guys executed. And sorry about all the changes on our side, but we had to make it a little more exciting.
You're very welcome, Ari. So just very quickly wrapping up, last question that we have, again directed towards me, is where are we lending as people transition to new markets? Are we lending in Class B markets? Are we lending in rural areas? And the answer is that we're lending in 45 states at this time, predominantly major MSAs or the major cities. We don't really look at rural areas just because we can't securitize those notes. But we're generally open to the vast majority of the country, with that being said. So with that being said, I'm really grateful that we're able to have these rock stars, these real estate titans on today. Lance, Ari, Gabe, thank you all so much for joining.
Oh, thank you. Appreciate it.
Thank you, guys. Yeah, you guys were spectacular. Very good. Learned a lot. Very educational. Very informative. Andrew, you are going to do a 3-webinar series with us. We're going to have you back in May, later part of May. Do you have an idea as to what type of panel you're going to come back with? This was spectacular. This was really good. But something similar?
Thank you. We're going to have some iconic individuals in the real estate sector. The CEO of one of the major funds, Turac. We're having John Beecham.
Very good.
And we have 2 of the most active attorneys in the space, John Hornick and Kevin Kim.
Very good. Okay. We're familiar with John Hornick. We had him here on one of our events. So guys, once again, thank you so much. We will be getting the video completed within a couple of days. And I want to thank the We Lend and thank them for sponsoring this webinar. And we want to thank all you that registered today. And once again, I will make sure that whatever questions were not answered, we'll try to get those answers out right away for everybody, okay? So once again, thank you, and this concludes the webinar. Thank you, everybody.
Thank you, Anthony.
Thank you. Thank you, guys.
Yeah.
Thank you, Andrew.
Take care, guys.